ADR represent a multiple of what? Underlying shares, right? Underlying foreign shares of the stock. And ADR can be traded in the US exchange, both on NYSE and what? NASDAQ. So all options for this ADR statement are correct. So we will choose the D. Next one, we will see some calculations, right? In the Frankfurt market, Frankfurt is in the German, right? Aldi, right? Aldi is a famous grocery store in multiple countries. In many countries, we can see the Aldi, right? And also in the New York City, right? You can see the Aldi, right? In the Queens, right next to the Costco. And Aldi is also very popular in the other state, right? Some state like the Ohio, they don't have food, they don't have the Trader Joe, but they have what? They have Aldi's, right? Aldi's stock closed at 5 cents per share. Okay, because we mentioned Aldi, right? So maybe I can give you some experience, right? For what I purchased in Aldi before, right? Aldi, they selling many different groceries, right? And they also offer special selections, right? From German, right? You can buy the bacon and the other sausage, right? From the Aldi, right? The price is very cheap, right? And also most goods in Aldi, right? The price is cheaper than Trader Joe, right? The Trader Joe is very popular, right, in the New York City, right? But the price is not competitive compared with Aldi. Right? Aldi usually selling the goods with a lower price, right, than Trader Joe. And in this question, you can see here, right? Aldi stock closed at what? €5 per share. On the same day, Euro US dollar spot exchange rate was what? 0.625 per dollars. Aldi trade as an ADR in the OTC market in the United States. 5 underlying Aldis were packaged into one ADR. And what's the no arbitrage US price for one ADR? So let me show the detail for these calculations, right? You can see this is the ADR. This is the let me put these two, right? This is ADR. This is stock. So in the Frankfurt, right, in the German, and this is in the US, right? So you can see here, right, in the German, right, the Aldi stock closed at what? €5 per share. On the same day, right, US dollar spot exchange rate is what? 6.25, right, for $1. And also, Aldi is traded in a OTC market, right, over-counter market, right? And how many shares will be for one ADR? You can see here, right? 5 underlying shares will combine into one ADR. So you can say there are 5 shares of stock, right, into one ADR. So what's the price of the ADR in the US? You can see here, right? 5 shares into one ADR, right? So what's the value for 5 shares in the euro? Will be 5 times 5 equal to what? Equal to the 25 what? Euro, right? And in the US, we will not use euro in the US market. We will use what? Dollars, right? So what's the value of the 25 euro in what? In the dollars, right? We will do what? We will do a translation, right? So we will use 25 euro divided by what? 0.625, right? For $1, right? So 25 over 5 over 8, right? So 25 times 8 over 5 will be equal to the 40, what? $40, right? $40. So that's the answer, right? That's equal to what? $40, right? For one ADR in the US market, right? So let me know if you have any questions. These questions is directly from our homework, right? You will see similar one in a final test, right? So make sure you can solve this one at home. Next one, very similar to this question, last questions, right? This one we will use what? Rolls-Royce stock, right? You know this is a luxury car brand, right? In London market, right? This Rolls-Royce stock, right? Close at what? 0.875 pound per share. So in the UK, right? The stock is traded with what? 0.875. On the same day, the British pound sterling to US dollar spot exchange rate was what? Was 0.6366 pound per dollar. So what's the value of this pound in dollar? You will use this one to divide by this one, right? On the same day, on the same day, you can see here, right? On the same day, Rolls-Royce trade as an ADR in the OTC market in the US. 5 underlying Rolls-Royce shares were packaged into what? One ADR, right? So 5 shares of the Rolls-Royce, right, stock will convert into what? One ADR, right? What's the value of ADR in the US? You see it's the $5.75. Right? So you need to what? You need to check what's the difference between these two values, right? So what's the potential arbitrage what? Trading profit, right? What's the potential trading profit, right? Okay, so let's compare this price. So if you want to compare price, they must be in what? Use the same currency, right? So US we use dollars. So this one we also into dollars, right? So let's say what's the value of these 5 shares of the Rolls-Royce stock, right, in the dollars, right? So we have the 5 times what? 5 times 0.8875, right? Then divide by what? 0.6366. After you solve this one, right, it will be the price in US dollars in what? In the UK. This one will compare with this one in the US, right, to say how can you make what? Arbitrage what? Profit. All right, you can see here, right? After you finish this one, it's equal to what? Equal to the $6.87, right, in the UK for these 5 shares. But in the US, right, it is what? 5.75. So which one is cheap? Which one is more expensive, right? You can see here, right? UK is what? Is more expensive, right? But US is what? Is cheaper, right? For these 5 shares. So now you can form what? You can form a arbitrage strategy, right? To using this what? To use these benefits, right? To use this price difference, right? Between these two countries, right? So let's say how can we what? How can we make a arbitrage profits. First, we will buy something what? Cheap, right? Buy something cheap and sell something what? Expensive, right? Simultaneously to make our arbitrage profit, right? So first, we will borrow dollars, right? You get a loan, for example, right? To buy what? To buy, for example, 1 ADR in US. So you borrow what? You borrow $5.75 in the US, right? To buy this 1 ADR. Then you will ask the bank, right, to transfer this ADR what? To 5 shares. And then you can sell these shares, right? In what? In a UK, right? Simultaneously, right? If you want to do a simultaneous, not go through this process, right? You can directly what? Borrow 5 shares, right? And sell in what? In the UK. How much money you can get? If you sell 5 shares in the UK, right? You get what? $6.87. But if you borrow the share, you want to pay the shares back, right? You can use these 5 shares you get from the US directly to what? To repay these 5 shares you borrowed in the UK, right? To buy the shares in the US, right? You spend what? $5.75. And in the UK, when you sell this stock, right, you get what? $6.87. So what's the benefits? What's the profit? Is 6.87 minus 5.75 equal to what? $1.12, right, for these 5 shares. So that's how we use this arbitrage trading what? Profit, right? Be careful for arbitrage. You want to buy and sell simultaneously, right? So in the US, we will buy dollar to buy share, right? In the UK, we will what? Borrow the shares and then what? And get dollars, right? So you can say that must be done simultaneously, right? To get an arbitrage profit. So that's how arbitrage profit will work, right? In our real market, right? Buy and sell at the same time. Okay, let's go to our new chapter, right, in a global portfolio investment. So let's say some questions. Suppose you are Euro-based investors who want to sell the what? Microsoft stock you bought 6 months ago. You investing what? You investing 10,000 euros to buy these shares, or $120 per share. The exchange rate was what? $1.15 per euro. Now you sell the stock for what? $135 per share and convert to dollars into what? Into euros, right? For exchange rate, what? $1.06 per euro. So what's the profit, right? And also from this profit, how much comes from what? Comes from exchange rate movement. And you can see our exchange rate is different while you buy and sell it. And so your return is not just for the what? Price change. It's also including what? The change of exchange rate. That's the special feature for this course only, right? All your costs you studied before is in the US market. But when you do investment across the countries, right? Your investment will be also impacted by what? By the foreign exchange rate. So that's a special part for our course only. Right? So let's say the beginning price beginning values, right? You purchase your stock, right? You got what? You got 10,000 what euro to buy this stock, right? Forward, around $20 per share, right? But this is the euro. That must be convert to a dollars first, right? So this one will times what? $1.15 per euro, right? So this dollar will divide by what? $128. You can see how many shares for your Microsoft stock you can purchase, right? And when you sell the stock, right, you got how much per share? $135 per share, right? And this is the how much you can sell in the US market. But you want to determine the profit in euro terms. So you also need to transfer this one back to what? To the euros, right? By divide by what? Divide by $1.06 what per euro. So that's the value when you sell this stock, right? What's the amount you can get in what in euro? That's the ending values, right? What's the beginning values? Is 10,000 what euro, right? Like this one you see here, right? So the difference will be what? Will be your profit, right? Will be the profit. So please write this one down in your notes, right? Maybe you can see the similar questions in your final, right? What's the value you can sell the stock in the market while you transfer back to euro minus beginning values when you do this investment, that will be the profit you can realize, right? For this investment. And for this profit comes from what? Comes from the two parts. The first part is very easy, right? Just what? Just the price change, right? You see the price beginning is what? 120. Ending value is what? 135. So the price change in percentage called capital gain, right? So capital gain is what? Is this part, right? Equal to what? Equal to the 12.5%. Next one is forward. The next one is for the change of what? Exchange rate. Right? A change in the exchange rate. What's the exchange rate at beginning? It's $1.15 per euro. $1.15 per euro, right? While you sell this stock, right? What's the exchange rate? $1.06 per euro. And we try to make the return in the what? Euro terms. So let's say what's the return, right, between these two exchange rate. So for the same dollar, what's the euro in the beginning? So should be $1 or what? $1.15 per euro. While you sell this stock, right? What's the euro? About $1, right? Values, right? How much euros? For 1 over what? 1.06. You can see that's the difference, right? From the beginning to the end. And this change over the beginning values, right? 1 over 1.15. So you solve what? You solve a return part forward for the change of exchange rate. So this is for the exchange rate appreciation, right? And this is from what? This is from the price change for the stock asset itself. And so you can see our return comes from the two sources. One source is what? Is the price change for our investment. Second is what? Is the dollar's appreciation, right? You are German investors, right? However, you are lucky, right? You put your investment in the US, right? The dollar is what? The dollar is appreciate, right? For the same euro, you get what? Less dollar. So dollar is appreciation. So when you convert your dollar back to a euro, right? You can enjoy the part for what exchange rate change, right? So you can say our return will decompose into two parts, right? One is the capital gain, one is the dollar appreciation. So in the final, you can see the questions ask you to solve what? Solve the part for the capital gain and also the part forward for the exchange rate appreciation. You must to know these two calculations well, right, to handle the question in the final. So that's the problems we cover here. Right? Do you have any comments or any questions you want me to repeat or to address again? So let me know. Right? You can either talk to me directly or you can put in the chat. Next questions is also very good, right? So we will check this one, right, with the details. Miss James K. Saber, global investors just sold a share of what? Nestle, right? A Swiss firm. Nestle is famous for the coffee, right, maker, and for the Swiss franc 5080. The share was bought for the 4600 a year ago, and we also see exchange rate below. And for the stock, you know you can receive what? You can receive dividend. So what's the return for this investment? Right? Be careful. We must to solve return in the terms of what? US dollars. So everything in the calculations must be in the what? In dollars. You see the price you purchase is what? 4600. While you sell the share, the price is what? 5080. But these two are both in what? In the Swiss franc. The question asks you to solve return in what? In the US dollars. Right? So you must to transfer this Swiss franc to what? To a dollar first. What's the exchange rate at the beginning? 1.78 Swiss franc per dollar. Now what's the exchange rate? 1.6 Swiss franc per dollar, right? So you can use exchange rate, right, to solve the dollar by use what? Use the division, right? And this is the ending price. This is what? Beginning price, right, in the dollars. And also we receive what? The dividend, right? So when you selling the stock, you not just receive the 5080, you also receive what? You also receive dividend 120, right? So that's how much you get in total while you sell the stock. And then you see this ending value, this beginning value. So our ending value minus beginning value divided by beginning values times 100% will be the return, right? So you can say this one 5080 plus 120 over 1.6 minus 4600 over 1.78 divided by 4600 over 1.78, right, will be the return for these calculations, right? If you have any comments, right, please let me know. If not, I will continue to do the next questions. And these questions you are more familiar, right? Because these are the same questions we did, right, in the homework. Japan Life Insurance Company investing what? $10 million in a US bond on May 1995. After 1 year, right, the company liquid sell this investment, right, forward for $650,000. What's the return for this investment? Be careful, right? Our investment is in the US. But our company is in what? In Japan. So let's add exchange rate or foreign exchange, right? Risk between these 2 years. And you can say our exchange rate at beginning is what? 80 yen per dollar. But when they sell this one is what? 110 yen per dollar, right? So let's say what's the total return? You can say our ending values, right? Will be what? Will be 10, 650,000. That's the value when you sell this investment. What's the yen for this amount? Will be times 110 yen per dollar. This end values. What's the beginning value? It's $10 million, right? Times 80 yen per dollar, right? So you can solve return. Use what? Use the 10,000, right? Times 80, and this one's the 10,650,000 times 110, right? Take a difference then over the beginning values. That's the return in what? In the yen, right? That's the return in the yen. You can see the calculations here, right, in the detail. But when we go to the next slide, let me explain something for these questions in the more detail. You know this total return, right, has the two parts. The first part comes from what? Price change. What's the price change for this investment? It's 10,650 minus 10 million over 10 million. That's the price change. Or you can see the capital gain. Right? The other source for this return comes from what? From exchange rate change. Right? The dollars are what? Are appreciate. Right? When a company purchases the bond, right? It is in the 80 yen per dollar. But after 1 year, it's 110 yen per dollar. So dollar appreciate. So this investment also enjoy extra benefits because the dollar appreciate in the US bond. So we have the 110 yen minus 80 yen divided by what? 80 yen, right? Because our return is calculated in what? In a in a yen's term. So we use the 110 minus 80 divided by what? 80. So our total return can also solve in what? In these two calculations that adding up. This part is called a capital gain, but this is called what? Appreciation of what? Investment currencies, right? Next one, right? Next one is for the global portfolios, right? You can say the stock are invested in what? In the both market. One is the US market, one is the UK market. US market offer this return and risk. UK market offer this return and risk. So what's the expiry return? What's the standard deviation risk for these global portfolios? Expiry return equal to what? Weight times return plus the weight of times return for another one, right? What's the weight? You can see here. Our portfolios are what? Are equally weighted. So it means 50% in the US, 50% in what? UK. So we have the 0.5 times 1.26%, right? Plus 0.5 times 1.23%. So that's equal to what? 1.245%. That's our expected return for these portfolios, right? And what's the global portfolios risk? Risk will be solved as what? W1 squared, sigma 1 squared plus W2 squared, sigma 2 squared plus 2 times W1, W2 rho times sigma 1, sigma 2, right? And you can see first part is the 0.5 square, right? 4.43 square plus 0.5 square times what? 5.5 square, right? Sigma means the risk, so this is the sigma, right? And this is the weight, and this is the return. Plus the 2 times what? 0.5, 0.5, right? Then times the correlation, the correlation coefficient is what? 0.58, and then times the each sigma here, right? So our risk, you see, will be the square root of these summations equal to the 4.44%. So this is how to solve the global portfolio's risk and return. I use something we have studied before, right? In the return risk, right? In the finance class. Now let's say something different, right? Let's say something different for this course. When we try to combine different stocks into our portfolios, right, from different countries, we must to, understand there was something called international correlation structure and risk diversification, right? You see, when you put different stock, right, into one portfolios, it will be have what? It will be have less correlations, right? Because the country share different, things, right? For example, for different countries, they have different what? Economic conditions, right? Also, the political institutions and even psychological factors will be different among different countries, right? You see the US and Russia has totally different what? Political situations, right? And also economic institutions and even cultures are totally different, right? Are very different across different countries. So it will result in what? Low correlations among the global securities. You see here. If this was a country stock, right? And this was the B country stock. And you can see when A moving up, B is what? Moving down, right? So they have different what? Cycles, right? So when you add these two up, right, your portfolios will what? Was relatively low risk than each individual country stock, right? Your portfolio will have even lower risk if you can combine these two right, into one portfolios, right? How can we apply this knowledge right into our real investment? You can see here. Even for this special period for our, COVID-19 pandemic, different countries can show different paths. Some countries already control the pandemic, right? But some countries maybe only has the beginning of outbreak, right? So you can see the stage of the pandemic are different, right? If you concern about this impact of the COVID-19, right, into our economy, you can try to put different what countries stock into the portfolios, right, so to reduce risk, right? For example, this is the US chart, right? US chart, right? This is from the Morgan Stanley, right? You can see what's going on in the US, right? This is based on the Morgan Stanley's model, right, for the outbreak of the pandemic, right? Until we are certain this will be controlled, right? Will be experienced about what a whole year, right? So you can see now we are on what on a May, right? So our case are gradually reduced, right? And we have the more capacity of the hospital, right? And more availability of what ventilators, right? Our new case for what for going down, right? And for the summer, because the temperature and also right? With the control of the spreading in an early stage, right? You can see our case will almost touch what? Zero, right? And if there are vaccine, right, will be approved sooner, right, under FDA guidance, right, then we have the potential vaccine will be available for the healthcare workers, right? So if that one can be done, right, most people can go to the normal life, right? School will be reopened, right? And we can, go to the normal working and study. However, in the winter, right, it will be potential second wave of what? Infections because the virus can be more active, right, in the winter, right? So that's the potential model forward for our COVID-19, right, from the Morgan Stanley. Right, you can see that's what's going on in the US right now, right? So this is a curve for the US, but this curve can be totally different from what? From the other countries. For example, Russia. Russia actually now with very fast growth of the confirmed case, right? And they are actually just on this part, right? On this part, right? Italy is on this part, right? It's almost controlled by this pandemic, right? And some countries on this part, right? Some countries on this part, some countries on this stage, right? So if every country share different paths, right? Because the timings, right? Then recover and reopen will be totally different, right? So when you try to inviting across the countries, you want to pay attention to these timing issues, right? You can choose the stock, right, from different countries to reduce risk. For example, if you consider there will be a potential second wave of the infections, right? So during this time, you can short some US stock, right? You can short some US stock, right? And if you know our, control of the pandemic is on the path, right? You should buy some stock, right? Hoping the economies will getting, recover very soon, right? So our stock market will performing, you know, better and better during this period, especially before the president elections, right? I think market will continue going up, right? So I also, put a recommendation for the stock, right, in the previous lecture, right? If you have interest, you can also, you know, relate this curve, right, to your investment, and to make some, you know, investment if you want, if you can, right? For example, in the past week, right, we know the Tesla and Zoom are very good investments in the market, right? They also performing very well, right? Tesla is more than 800, right? Zoom is more than 150, right? If you purchase these two stocks, right, you will get a high return, right? And also, I mentioned, one vaccine company, right? Moderna, right? Moderna is increased more than 50%, right, in the past 2 weeks. Right? So I think you can think about this company, right, for the investment, but now the price is already high, right? And I see in a chat, right, one student asked about what? Beyond Meat. Beyond Meat is that similar to a Tyson? Tyson is do the meat processing. Is that Beyond Meat also do the meat processing? I'm not sure, right? If the Beyond Meat is also do the meat processing, right? I think the price will gradually, recover, right, in this one or next week, right? But it will not, growing very fast compared with the other technology companies. Okay, so I hope this curve can give you some thoughts, right? Especially about, how you will prepare, how will you prepare, right, for the next matters, right? I think you can get some idea, right, from this curve, right, from Morgan Stanley's, right, models about this COVID-19. How about BA and Boeing, right? A Boeing can be a long-term investment, right? Boeing's price will be increasing, right? But it's not sure. We are not sure how soon it will cover, right? And for the Warren Buffett, right? He sell all the air flight company stock, right? Like the UA and American Airline, all the air flight companies, right? He sold off, right? And also the Boeing, right? But we know Boeing will eventually maybe recover, right? But not go back to the previous level, but it will gradually recover, right? So you can buy the Boeing for long-term investment. For BA, BA is that the what's the BA's full name? Can you give me the full name of the BA? Oh, BA is the Boeing's, right? Boeing's a ticker, yeah. So Boeing's for in a long-term investment, and also Trump, of course, will support Boeing. If not, right, Boeing is the major export for U.S. right, for industry goods, right, export. Boeing is the major export, right. So I think the government will not like the Boeing down, right. It's too big to fail, right, like the AIG in the 2008, right. So eventually, Boeing will go to right track, right. Boeing is already back to the productions, but it's not the 737s, right, but the other lines are in a recovery, right? So the BA can be a protected stock, and also Walmart can be a protected stock, right? Because Walmart next week will release their earnings report, right? And Walmart is still doing a right business, right? During this pandemic, right? People buy online, right, from the Walmart electronic platform, right? And also people go to the Walmart from most states, right, to buy grocery. And so Walmart can be also a potential, right, for long term. Okay, next I would like to show the summary statistics, right, for the return among different countries. And this chart is very important, right? You will see some questions in the final to interpret, right, these different columns. So the first column, the first part of the columns, right, is what is the correlation coefficients. What's the correlation coefficients means? Means the connection between what? Between one country and the others, right? In the pair, right? In the pair. For example, Canadian stock market has 0.68 correlation with what? Australian market. So which two countries has the highest correlations? So let's check the number. You can see here, right? We have what? Highest number, 0.79, 0.79. So Germany and the French market has the highest correlation. Also, Netherlands and the French market has what? High correlations, right? What's the meaning of correlations? When the market in one country volatile, right, get fluctuate, the other country will usually change in the same way, same directions, right? And then the higher of the correlations, right, will be moving with small connections, right? That's about correlation. Next one is for the mean. Mean means what? It's by return. So which country has the highest? It's by return. You can say that is what? That is the 1.28. That's the Hong Kong stock exchange, right? Generate a highest return. And we studied our finance before, right? If you want to get a higher return, you also need to take more risk. So you can say Hong Kong provides a highest return, also has our highest risk to do investment. So based on this return risk, you are not sure which one's better because the high return also accompanied with what? High risk. So how can we, determine which market is the best? We will use what? We will use our Sharpe ratio, right? How can we use the Sharpe ratio? So that's our questions in the final you need to solve, right? What's the Sharpe ratio? So Sharpe is after the name of what? William Sharpe. William Sharpe is the father of what? Modern portfolio theory and corporate finance, by modern corporate finance, and he won the Nobel Prize, right, for his contribution. And this ratio is after the name of the Sharpe, right, so-called Sharpe ratio. Sharpe ratio itself is what? Return of your assets, right, either portfolios or equities, right, minus what? Minus risk-free rate, then divided by what? Divided by risk. So this is a measure you can use to compare which one is the good investment, because these formulas give you what? For one unit of the risk, right? How much return can generate. So the higher of the Sharpe ratios means with a certain risk, you can generate what? More return. So based on our calculations, right here, which one give you the highest Sharpe ratio is what? It's US market, right? So US market actually rank number one, right, among these countries, because with a certain risk, US generate what? Highest return. It's not Hong Kong, right? Hong Kong return is high, but also risk is high, right? So Hong Kong is only ranked on what? Number 5. Number 2 is what? Switzerland, right? You can see the Sharpe ratio is what? 0.134, right? So we will use Sharpe ratio to compare different investment, right, to see which one performing better. And also we have a column forward for beta, right? What's the beta means? Beta measures the sensitivity of the what? Market to the world market, right? So our whole world market is a benchmark index. The beta measures the country stock market, right, relative to what? To the whole world. If you have a low beta, right, means you are not very sensitive, right, to the whole world market. If you have a higher beta, means you are more what? More sensitive, right, to the world market. For example, Japan has what? 0.96. US have what? 0.88. So Japanese market are more volatile, right, to the world market, right, than US market. So when the whole global market gets volatile, the US market is less what? Less volatile compared with what? With Japan. And that's the beta tells you about. And then you see these tables, right, also explain, what happened, right, with the correlations, right? You can say all the correlation here in this triangle, right, is less than what? Less than 1. You don't see any numbers more than 1, right? Means they are not what? They are not perfect correlated, right? If they have the not perfect correlated correlations, right, means you can pull this stock into our portfolios to reduce the risk. So you can diversify your portfolios, right, with the global stock, right, from the other countries to reduce risk compared with you investing in the domestic market purely, right? You see our risk formulas, right? Is what is the W1 sigma 1 squared, right, plus W2 sigma 2 squared, right, plus the 2 W1 W2, right, rho sigma 1 sigma 2. If a rho equal to 1, right, our sigma will be what? Will be the weighted average of W1 sigma 1 plus what? W2 sigma 2. And you can see our rho here, right, not even equal to 1, right? So of course, with the pulling of the foreign country stock into portfolios, your risk will be reduced. And let me show some evidence for that. Okay, you can say if you only invest in a Swiss stock or US stock, right, the risk will be in this level. For example, if you invest in the US stock only, the portfolio risk will be what? 0.27. But if you adding more and more stock in the US, right, your minimum risk you can touch is 0.27. For the Swiss stock, risk will be higher, will be 0.44. Even you adding more and more stock in these two portfolios, you cannot reduce risk anymore. However, if you putting the stock from these two countries into our portfolios, right, you can see the risk will be below both countries' stock portfolios. Right? So means the international portfolios with the different countries stock inside will be reduced with more risk. So that's the benefits of what international what diversification, right? That's also confirmed the trend in the Wall Street. Right? In the Wall Street, 10 years ago, not too much of the active will be invested in the foreign market. Now there are more than half of the actives are also allocated in the foreign market. Right? So you can see that's the reason. So what's optimal international portfolio selections? The correlation of the US stock market with the return the stock on the stock market in other countries can be different, right? US market with more correlation with what? With the Canadian, right? Because we are in the same time zones, right? Same time zones, and also, we have a close trade connection with what? Canadian, right? And also, we are the neighbors, right? So there are so much similarities between the economy and also the other conditions between the US and Canadian stock market. So our correlation is very, very high, 32%. But US market is with a relatively much lower correlation with what Japanese stock market, only 31%. Right? So only less than half of the correlation between the US and Canadian. So you can see the US investors can get more diversification rate benefits from investment in Japan than Canadian. Because if you put the market put your investment in the Canadian, most likely the US market if volatile, if going down or going up, Canadian market will have the same trend. However, Japanese market will be more diversified than the Canadian market. Right? So it's quite different from the US market. Right? So you can see we have low correlations. Suppose the US market is going down, right? The Japanese market, maybe the trend will be different. Right? That's the benefits of what if you put investment in a lower correlation for countries. So here I also summarize the monthly return, right, for the countries between the 1980 to 2007 before the financial crisis. Right? And for return here, in the column is the monthly return. How to solve the annual return? You just times 12. Times 12. Right? And you can see here. Right? Also, before the financial crisis, right? You can see our friends market, right? And also the other market performing even better than US. However, after financial crisis, right, US even performing better than the other countries. So our financial crisis actually is spreading to global. Right? So which countries were affected by this crisis until most? It's not US, but the other countries like the European, for example. Right? And the US actually recovered very well after financial crisis because our currency dollars is a denominating currency, dominating currency in our world, right? So we can print money to support our recovery. And here I also show how to choose, how to select optimal global portfolios. As you can see here, our global portfolios are formed with the multiple countries portfolios inside, right? And when you use the macro weights division the frontier, you see this is the optimal international portfolios, right? As you can see, return is will be what 1.48%, right? Risk will be what 5.0%. Right? What's the annual return? It's this one times what 12, and this one raise for annualized will be this one times what square root of what 12, and square root of 12. You can see here, right? Before the financial crisis, right, for our optimal international portfolios, right, or including what stock portfolios, right, from the different countries, right, the Wall Street put 20% in the US market, right, and also have the investment in the other countries, right, to diversify our portfolios, right, not all in the US market. But after financial crisis, because Europeans get hurt a lot, right? So the Wall Street actually get money back, right? Who reinvest in the US with the more weight. Okay? So that's a very very special phenomenon in the industry, right? In the market, in the global market. So when the global has any crisis, for example, right, like this COVID-19 pandemic, right? Most countries will get hurt a lot, not just US, including all the countries, right, will get hurt for the global financial crisis, or like this pandemic, right? But if the whole world has a crisis, where the money will flow to? The money will flow back to US. Right? So US is the harbor for the safe money during the financial crisis. Right? So if you cannot choose the right investment during the financial crisis, right, most investors will choose to put their money back to US, and also even the foreign countries, right, they will inject more money into US because the US dollars is the main currency on the world. Right? So after financial crisis, right, there are much more weight in the portfolios are allocated into US market, but much lower capitals in the foreign markets. Right? But this one can cause a problem for the foreign countries, right? Because they will short of the capital and they will go toward bankruptcy. For example, you know what happened in Turkey, and you know what happened in Asia, some small countries. They all experience a very tough time after 2008 financial crisis. In the US, only a few big companies, right, get bankruptcy, but not for the whole industry. Right? But for the other countries, will be totally different story. Right? The whole country can go to bankruptcy. Right? If you watch the movie I provide online, right, for the final paper, right, you can see the big shot, right, is for 2008 financial crisis, right, and default is for the financial crisis in South Korea. Right? South Korea, the whole country will default. They don't have any reserve. What they will do, they will go to the foreign country to asking for a loan, right? So you can see the South Korea government, right? They take a flight to US, to the IMF, to apply for a loan. The situations will be very tough, right? Because if you want to borrow a loan, you must have our collateral. What is collateral for this loan? It's for the whole country, right? So South Korean people even sell their jewelry, sell everything the pressures, right, to help the government to apply the loan from the IMF. Right? Even some people are suicide during this crisis. Even this is much more, you know, sad movie compared with the Big Short on 2008. This one is more severe for the country level. Right? So you can check the difference if you're watching the movie online. Next one, let me show something on what for the gains from the global diversifications, right? For US investors, right, OIP has more return and what? More risk. The Sharpe ratios, right, has what? 40% higher by suggesting an equivalent risk. Optimal international portfolio will have more return unit the risk than our domestic portfolios. You can see here, right? This is the optimal domestic portfolios, right? This is the optimal international portfolios, right? So this one is the Wall Street put all the money into domestic market. So this one is in a global market. You can see the Sharpe ratios, right? Which one is higher? This one is what? Is higher, right? So means for the same risk, right? For the same risk, our global exposure will help you to get more return and more return. So let's follow global portfolio diversifications, right? So let me also help you to review the formulas we did and discuss at the beginning. Again, our return has what? Has a two part. Once the return from what? From the price change in a local currency, and once from the change of the exchange rate. And our returns will be solved as what? As the 1 plus the return in a price change of the asset in a domestic market plus the change times the change of what? Exchange rate. Use the geometric mean of return. So R will be solved in this way. If you're expanding the whole bracket into the terms, you see that the 1 times 1 will be 1, and Ri times 1 will be Ri, right? And then EI times Ri will be EI Ri, right? So you're expanding this one, we have 4 terms, right? 1 minus 1 will be cancelled off. So basically our total return, including the 3 terms, this one, and this one, right? This one is the return for the capital gain, right? This is the return forward for the currency appreciation or depreciation. This one's a cross product. But in our previous calculations, this one's done. Why this one's done? Because this one's very small. Both R and EI are percentage. If you do the cross product, the number will be even smaller. Right? It will be like 0.00 something. Right? So we will ignore this part when we solve this return. Right? But if you want to do this one more accurate, you can add in this cross product into the calculations. For example, if you are US president, just sold shares in a British firm at our 0.15% return in pounds. And also, the dollars are what? Appreciate, pound depreciate, What's the return in dollars? What's the return in dollars? Because the return is calculated in dollars, so it will be included in 2 parts. The first part is the return on what? Return on a domestic asset, right? That's the 15% in a pound. And also we have the return from the dollar appreciation in a foreign, in the US market, the dollar's appreciation is appreciated, right? You can see that will be the 5% loss in the pound, right? Because the domestic market currency appreciate, right? Your investment in the foreign markets currency are depreciated, so -5. So this one will be 1 plus 15% times 1 minus 5%, right? Then -1. So you can expand this one like the formula we just showed before, and this one will equal to here, right? Will equal to the 15% plus minus 5%, right? Then plus what? 15% times minus 5%, right? So this one is the RI, this one is EI, and this one is RI times what? EI, right? 3 times, right? This is the change of the exchange rate, and this is the return rate. So that's how to solve return. In a industry or in the market, right? For the convenience, right? We will just ignore, this part. This part is very small, right? So for convenience, we just use what? Your return from the price in, right? Minus the price change, right? Plus the price change, the depreciation of the foreign currency. Or here is depreciation of the foreign currency. Right? So we'll approximately equal to what? 10%. Right? That's for the convenience. Or for more accurate, right? You should what? You should add in this part, right? And for risk, right? This is for the return, right? Including the 3 terms. For risk, we will do a very similar thing, right? Including a risk for the price change, risk for what? For the exchange rate change, right? And also have the cross, change between asset and exchange rate. And so that's the 3 terms you have. So you can stop this one by measure the volatilities for its own investment, and also something for the currency. So this formula is not required. I only need you to understanding what the risk comes from this formula, right? The risk for the global portfolios, right? If you do investment in the foreign countries, comes from the 3 parts. The first part comes from the asset, the price change itself, right, in the domestic currency. Second, it comes from the what? Comes from the risk from the foreign currencies exchange rate risk. And we also have a special term for the covariance between the local market and the foreign exchange rate. So we have these 3 terms, right, in our risk management. And you can see, many students ask me in the previous class, do we need to buy any mutual fund, right, to diversify our portfolio? Right? Mutual fund, if it is a good investment to diversify your portfolio to reduce risk. So what's going on in the real market? You can see here, right? Let me try to give you some sense. Use our global mutual funds. And here's the data between 1977 to 1986. You can see here, right? The mutual fund perform a higher return than benchmark. Right? Than benchmark means for active investment, right? Mutual fund is managed by the what? By the professionals. Right? They are doing something called active investment. And so active investment really performing better than what? Than a benchmark, right? Because the market is not very efficient in all times, right? So you can see the mutual fund performing better than the market. But what's going on in the times right now? With the time passed, right? Especially on the 2000 up to 2008, our mutual fund actually underperformed of what? The whole index, right? Because up to 2008, right? Our market is growing faster, right? But our mutual fund, they need to charge our management fee, right? And also sometimes if you're bidding on some specific company, risk will be higher than the whole market, right? So you can see up 2008, not too many people to buy mutual fund, but they will choose by the index ETF, by index ETF. So they will do some kind of passive investment. Right? So passive investment is very popular after 2008. Because this one give you much lower risk, and also you don't need to pay the management fee for these portfolios. Right? And also some professional last week they mentioned that because Warren Buffett bidding on the whole U.S. economy, whole economy, and they think our economies will be what? Will be recover in the long term, right? But Warren Buffett don't buy any specific stock from the company yet because he said now is the time to hold in the cash to wait for opportunities, right? But in his belief, right, the market will continue going up, right? So in that case, maybe for us and for our individual investors, right, your best selections can buy some index ETF. Right? You know the market every day is most likely are gradually going up, going up, going up. Right? I think before the present elections, right, if the Trump want to be re-elected, want to win the elections, he will not let the market going down. If that happens, he will lose his chance. Right? So if that happens, the market will continue going up. And so if you don't want to take a risk to buy individual stock, now you can buy the whole index to buy somewhat S&P 500 ETF, right? So it will give you also a good return in the long term. Right? And now the market is lost like more than 20% compared with last year. Right? So if you want to bidding on the whole market, you can also buy the S&P 500 ETF. And we will not continue, the other part, right? For the next class, we will do our final review, right? Final review. So I will, first go over the questions we have in a homework, right? Now I will, based on homework, I will also give you some questions to practice next week. So please take the time to attend our next review class on a Friday, right? And I will also record a video on a Monday